IFRS 9 financial instruments will potentially impact your financial statements in three key areas. Firstly, IFRS 9 introduces a new model for classification and measurement of financial assets. The four financial asset classifications under IAS 39 have been replaced with three classifications under IFRS 9, being amortised cost, fair value through other comprehensive income, and fair value through profit and loss. Put simply, financial assets will now be classified on the basis of the cash flows associated with the asset and the entity's business model for managing the asset, instead of the defined criteria for different categories of financial asset that existed under IAS 39. Secondly, the new IFRS 9 impairment model is based on expected rather than incurred losses, and this will potentially lead to earlier recognition of impairment losses. There are three possible impairment approaches under the new standard, being the simplified approach, the general approach, and the credit impaired approach. The majority of entities will apply the simplified approach. Even when this does not result in a material change to the calculated impairments, companies will need to demonstrate that they have followed the model and method of calculating impairment as set out in the standard. Finally, there are changes to hedging. Hedge accounting will still be optional under the new standard, and on transition, companies can make an accounting policy choice to continue using the IAS 39 requirements. Hedge accounting under IFRS 9 is more principles-based, rather than the rules-based approach under IAS 39. The use of hedging is more closely aligned with the risk management objectives. The onerous retrospective and prospective effectiveness testing requirements, which put a lot of companies off using hedge accounting under IAS 39, have been replaced by simpler hedge accounting effectiveness testing. There is also more flexibility to apply hedge accounting to groups of items, including net positions, so hedge accounting can be adopted on a more entity-wide basis. This could make hedge accounting a more accessible and worthwhile approach for some businesses.